Hello everyone, welcome to the Fotis Trading Academy. In this short video, we will attempt to define and explain short and longer term macro factors that are affecting global financial markets. So let's begin with United States. We will begin here with the industrial sector ETF, XLI. So this is the industrial sector ETF. You can see we do have a move higher. However, this is just a correction and we do have a series of lower highs. We are also operating outside the main rising trend line. So we have broken the main long term that was on the upside, and this is just a correction after the move from the highs in the end of 2017. So we did have a correction of around minus 10%, but now we see a move higher in the industrial sector. Why is this happening? This is happening because we do have an improvement in US economic activity as shown by the latest figures. For example, industrial production on a month-to-month basis came out at 0.6%, driving the year-on-year performance to plus 3.8%. Now this is very good, and also if we combine this with retail sales that grew on an annual basis at plus 6.6%, this is the highest figure since February 2012, you can understand that this is a positive development for the macro landscape in the United States. So let's recap again. Industrial activity improving, and this can be also seen here in the chart of the industrial sector ETF. So industrial production improving both on a month-to-month and on a year-on-year basis. Retail sales have been improving, the best figure since February 2012. Inventories have been improving. So you can see that in the short term at least, we have a good developments when it comes to macroeconomic factors for the US. Now, what we mentioned is important because we have the advanced GDP figure coming out this coming Friday. Now, based on the figures that I just explained, I just mentioned, industrial production, retail sales, inventories, I think we are going to have a good advanced GDP figure. And this is important because this leads to conclusions, very important conclusions about the yield curve and what is more likely to happen. You can see though that we are not talking about guaranteed outcomes, but rather than high probability outcomes. So short term, we see that there is a divergence between what is happening in the US economy and the rest of the world. However, before I move on to explain a few things about the yield curve, I just want to mention that I am optimistic in the short term. I can see potential for having a move higher in equities because we have some solid macro figures in the US, but there are other hard macro factors that are not so good. We already have the seeds of the upcoming recession. What do I mean by this? Well, industrial, as I showed you, the industrial sector is doing fine, retail sales are doing fine, inventories are very good. So this is positive for the short term, but take a look at this. This is something that worries me. I think the symbol is ITB. Sorry, let me correct this. Let me type the correct symbol. So this is the home builders, home construction index. And you can see that we have moved 20% lower from the highs. We did have a small correction, but we have broken technically outside the main trend line, and this is just a correction after a 20% drop. If you look at the housing data from last week, they have been very bad. We can see that new permits have slowed to minus 4.2% on a year-on-year basis, and this is not good because the first sector that gets hit when we are about to move into a recession, or let's not be so dramatic, when the economy is about to soft land, when the economy is about to start slowing down, the first sector that gets hit is usually the real estate sector. So you can see here home construction is lower 20% from the highs. And if you remember, the official definition of the bear market is a move from the highs of more than 20%. And we are reaching this. So we have some divergence also domestically in US data. Yes, industrial production is better. Yes, retail sales is better. Business inventories is improving. But I see this in home construction, and this has consequences for the longer term outlook. So in the short term outlook, I am expecting a good figure when it comes to advanced GDP coming out this Friday. And I think this is going to push the probabilities, expectations for higher interest rates in the US even higher. Let me show you this article and understand what is happening. Now this is a great article published back on the 29th of June. This is on MarketWatch. Here's when the yield curve actually becomes a stock market danger signal. Now we see these good economic indicators coming out from the US, industrial production, retail sales, inventories. But what we see happening is that the yield curve is becoming even more flat. It is becoming flatter and flatter, and if it continues like this, by the Christmas period, by the end of this year, by December, it will invert. So what is happening? What is going on? Why do we see this happening with the yield curve? We do see an improvement in the short term, but the expectations for the longer term call for an inversion of the curve, and that the US, for several macro reasons, will move into a recession. Now, this is a great article written by Mr. William Watts at MarketWatch, and it features information written by Mr. Brian Belsky, Chief Investment Strategist at BMO Capital Markets. So they say that even if we have a flat yield curve, that doesn't mean necessarily that we will move into a recession. Now, keep in mind that since 1967, an inverted yield curve has been a leading indicator for an upcoming recession. So an inverted yield curve has helped us predict a recession every single time since 1967. I think there was only one time since then that it failed to predict a recession. Actually, the opposite happened. But that's only once since 1967. However, we do not move into a recession until we have an inverted yield curve. If we have a flat yield curve, that doesn't necessarily spell trouble for equity markets. So as you can see here in this analysis, Mr. Belsky from BMO says that stocks can still perform during later parts of yield curve flattening cycles. And his analysis is very thorough and insightful and shows us that the performance of equities has been quite good even when we had a flat yield curve. So please do not think that if we have a flat yield curve, that means trouble straight away for equity markets. Yes, we have a flat yield curve. Yes, based on what we said, it is expected to become even flatter. If it continues like this, we will have an inversion by December. But until we actually have an inversion, a flat yield curve doesn't necessarily mean we are going to have a recession and a move lower in equity markets. So I think that applies for the short term, and given what I told you about industrial production, retail sales, inventories, and what are the expectations regarding the Fed moving forward, I think we should expect more flattening of the yield curve, but I do not think that this necessarily will push the equities lower, as I'm going to show you on the chart. I see other signs that make me believe that in the longer term, probably at the first half of 2019, we will realize that inflation and growth has peaked and we will move into a completely new macro regime. So let me show you some charts and tell you how we are going to play this. Now, based on what we said, in the short term, Longer term, I'm very positive on the euro, but in the short term, I can see that this is not happening yet. So our strategy so far has been to buy pullbacks at the bottom of the balance. As you can see, here is the value area low. So every time it approaches the 115.50 area, we have been buying the euro, but it has failed to break back inside the bigger composite value area. So the important level for us is 117.70. This is an important level, and only if it breaks and it is accepted back inside this area, we will have some good chances to test this high volume node here around 122, 123. The fact that it has been unable to break back above this value area low in the short term agrees with our view that we are going to have a solid advanced GDP figure this coming Friday, and that means further expectations about interest rate hikes from the Fed, and that is going to drive the yield curve even more flatter. So I'm expecting in the short term strength in the USD, if of course my prediction materializes and we have a very solid, a very good advanced GDP figure. But you can see in this area, price action at the moment agrees with my view, and there have been sellers at the highs of the balance. Let's see if that actually happens. If my prediction materializes, we are going to push this again at the bottom of the balance. Now let me show you here the dollar yen. I was expecting a few weeks ago a move below 110. That didn't happen, so I didn't take any action. We had the move higher. So now I have to adapt to the new conditions. I see that we have consolidation here at the highs. So given what is happening with the yield curve, the flattening of the yield curve, expectations about higher interest rates, strong Chinese outflows seeking US assets, I think we are going to have a base here right on these highs, and I can see this. You can see where this trend lower stopped, right here on the high volume node. And let me show you on the hourly figure, we are consolidating right on top of the larger composite profile. So for me, this is something positive. I have a positive bias in the short term, and I am looking for a break. I will be looking to buy a break of 111.50s. This is the area where I will be doing business if, of course, my prediction materializes and we have solid advanced GDP. And as I said, based on industrial production, inventories, retail sales, I think this is going to happen, and this is going to drive the USD again higher. Now, what are the risks to this? I'm going to mention this in a minute, but if you are going to understand the implications and what are the risks for this scenario, you need to pay attention to equities. So let's go and have a look at the S&P 500 hourly chart. And as you can see, I have overlaid the bigger profile as well. So as you can see, at the moment, we did have some sellers appearing here at the highs, but we have been consolidating similarly as the dollar yen at the top of the larger composite profile. You can see we have a balanced market, we have a balanced structure, price action rotates back and forth, up and down. If we have a move lower up until Friday, before the release of the data, towards the bottom at 2790, I will be inclined to buy pullbacks in the short term, right there on the high volume nodes. My view will change negative, actually very negative. I will be seeking an active short position below 2790. This is the figure that I'm paying attention for a short. My scenario will completely change if we move and close back below 2790. I also see a divergence between US that is in a much healthier and better shape compared to Europe. If I look at Europe, Eurostoxx for example, this is the hourly chart. Yes, we have a move higher, we still have a balance, but we have failed at the moment to break the value area high. If we move before the GDP comes out on Friday, Let me do this actually and you can see a little bit better. If we move above 3,480, the level is 3,480 in the Euro stocks, and we start consolidating outside, my expectation is that we are going to have a solid GDP figure, and that is going to drive risk-on sentiment. This is going to help risk-on sentiment, and I think it is going to drive the dollar and equity markets higher.